will be sharing some insights on what is happening in the multifamily market, specifically in America at the moment. I think we're just going to wait 5 or 6 seconds for another couple of people to jump online before we're going to start today. I think before we go on a little bit, we would like to actually just move over to our disclaimer where people can actually just have a read through at the moment. Just want to see if it switches over there. So yeah, just please familiarize yourself with the disclaimer there at the moment. This is just as part of our efforts to stay compliant in all the jurisdictions. And in short, what it actually just says is that Wealth Migrate will not be acting as an investment advisory, but we do try to give you all the access to the best information around the world so that you can make educated decisions on where do you want to invest. So please, let's take a minute or two to familiarize yourself before we jump on to the proceedings for tonight. We'll give it 10 more seconds. I see there's a couple more people jumping online tonight. We'll almost move over swiftly and start the proceedings. I think that's good. Okay, welcome everybody. I would like to just quickly run through the agenda for tonight, and I would promptly also like to introduce to you my colleague, Willie Ulofse. He is Head of Due Diligence and our Risk Assessment Manager with Wealth Migrate, and it's once again a great privilege to share another webcast with you tonight, and looking forward to share some information on what's happening on the fundamentals on that side. Welcome, Willie. Thank you very much for joining us.
Thank you, JP. It's great to be here again.
So we will be looking tonight specifically on the fundamentals when having to look at investing multifamily opportunities in the real estate markets. We will also at a later stage, after we've given you some tangible things to take away, to apply in any of your future investments, also show you how Wealth Migrate might be able to provide you some opportunities to start off your multifamily investment career. So I think before we move over a little bit, Willie, what's in your opinion the best way to summarize what is multifamily? I think South Africans are not really familiar with what the concept is. If you please might just elaborate a little bit so that people can take a little bit of a general understanding before we delve into what is important in this sector.
Great stuff, yeah. Thanks, JP. Yeah, so what is multifamily? I think for us, it's not a common word that we are accustomed to in South Africa. Essentially, it's in the US, predominantly it's called part of a commercial asset. It's institutional grade usually. What we find is that it's usually a multiple of separate housing units for residential inhabitants. So what you find in what is more common for us in South Africa is called apartment block, or several buildings within one complex, like a townhouse complex. So you've got high-rise, mid-rise, garden style, and walk-up multifamily units. It is managed by one property management company to ensure that the maintenance happen on regularly and looking after the tenant turnaround. So essentially what it is it's not a sectional title per se, where what we know in South Africa as sectional title units. Effectively it is under one title, and there is no body corporate, so effectively you as a property manager will have the complete rights into what happens and what rules apply. So it's not a body corporate where the tenants can actually influence what's happening. You provide the facility, and that's why you appoint a property management company that can look after the maintenance of the property as well as the tenancy. So we like it because it's a stable income provider. So just to summarize, multifamily is similar to a state, but just 400 units under one title. I think that in short is multifamily. As we go now through the next slides, we will sort of discuss more of the fundamentals, and we've got later on in the presentation also a beautiful picture of what a multifamily looks like. So Yeah, but let's get cracking. I don't know. Yeah, I think we want to just say that be part of this. You know, we want you to ask questions, and feel free. You know, pop us a question as we progress, and we can see if we can catch them whilst we're presenting. Otherwise, there's going to be some opportunities at the end of the presentation. All right, let's delve into the next slides.
Yeah, great stuff. Thank you very much, Billy. I think maybe what's important there, if this is your first time, or maybe tell us, have you heard about multifamily before? Do you have any understanding of what it is? Have you had any exposure to investments, whether it be locally or offshore in multifamily, and what's your comprehension of it? Let's see if we can get some answers before we start and compare them, what we will maybe end off with the end of the webinar. So I think moving on, we're going to touch on swiftly because, on what will be the 7 key things you need to know before you need to enter into investing into the multifamily sector. So tonight we'll be delving into 7 key factors, and we'll be going through them, and one of them is creating the capital value growth opportunities in multifamily sectors. We will also look at the constant growing demand in the sector and why this is one of the sectors that Wealth Migrate really considers as a stable asset class to invest in. We will be delving in why the millennial effect is such an important thing and trend to keep abreast of at the moment, and also how we can actually take advantage of this to see where the best opportunities are. We're going to look at how managing and maintaining of this asset class is a lot easier than the single to residential properties, and how you can maximize your opportunities and minimize your risk within the multifamily sector. We're also going to delve in a little bit why this is a little less volatile as opposed to call it the retail or industrial sectors and maybe even the office sectors, and that's one of the reasons why we're also looking into this. So, and lastly, we're going to finish off why it's important to have a turnkey partnership involved when looking at a multifamily investor. So similar to what Willie said, we want you to be involved tonight. We want you to participate. So I just want to see, can everybody show our screens there? We'll see our screens.
There we go.
My apologies for that. Yeah, just wanted to go a little bit back. So we did show you quickly what's the 7 topics we're going to be discussing tonight. But before we continue, please be involved, participate, ask as many questions as you can. We'll try to answer them dispersely. Billy is here on the chat box, and alternatively, if there's some good questions coming through, we will take care of them at the end of the webinar, where some actual other people can hear what's on the hearts of the investors on the side of the panel. So I think let's hop through to the first factor that you need to consider when investing in multifamily residentials. I think the biggest value and why we really like it is that the creating of the capital value growth opportunity that comes with the multifamily. The biggest thing for us is because it's based on the commercial valuation fundamentals, is that when you look at a real estate opportunity on the multifamily side, the value is not determined based on the supply and demand and the selling prices of in your area, but physically on the income producing capabilities that the asset consists of. Now, a really pro and the upside of that is that we can actually have physical inputs to increase this income producing capabilities, which will directly relate in the capital growth of your asset. Now, one of the biggest pros is that with effective management and the strategic implementation, this will allow you to periodically improve the net operating income of that asset, meaning that if we physically put a input to increase or reduce the expenses, we will directly correlate that at the exit of the property to increase the sale value of that property. And it swiftly moves over into the consolidation of that expenses, meaning that your net operating income is dependent on the expenses that you incur in this property. Now, if you manage to consolidate that under one roof with a good property manager, this will actually allow you once again to consolidate those expenses and once again make the income capabilities of this asset a lot more appealing. Also, another thing that's really important for us is that upon the lease expiry, or let's call it the nature of the lease profiles within a multifamily, because tenants typically sign 1 to 2 year leases, meaning that every 2 years when they actually do their leases do expire and they do not renew that gives the property manager an opportunity to actually refurbish and maybe spruce up the unit a little bit if you want, and actually ask get actual better asking rental rates based on what the market is doing. Meaning, if you look at the commercial and sector in specific, they tend to sign 3 to 5 to sometimes even 10-year leases, which is nice for the investor because of the stability of that cash flow. But if you look at the reactiveness over the short-term lease periods, if the market actually does undergo a significant growth, you can actually every year or two renegotiate and ask that rental prices for your new tenants to keep the value of your property relevant to what's happening in that market. So this is why we think it's a good asset class and why it's so much more appealing as opposed to a longer term lease profile of a typical office. So it gives a little bit of diversification in your portfolio at the end of the day. And I think I've touched on this a little bit, the rent roll activity and the adaptability of that on the market conditions is really something that a good property management can actually, when strategically implemented well, can force appreciation in the asset class. Now, moving over to a little bit, having a look at the consistent growing demand in the multifamily sector is, the apartments have been having a long run of success, specifically due to a number of factors accounting for the enduring strength of the apartment sector. Now, we will delve into this a little bit of detail, but if you have a look at the entry of the job market of the massive millennial generation at the moment is having a significant impact on what is happening in this specific, call it, market segment. It's also very prominent that the consumer's awareness of the for-sale housing product followed its massive loss in the value during the housing market crash of 2008. And we will delve a little bit later into detail why the volatility is so low in the multifamily sector. So what this effectively means is people actually, when they go through a recession, that if the properties have to sell, they can actually, or they tend to downscale into the multifamily, which actually does prove consistent demand in that area. Now, if you have a look at point number 3 there, the credit issues for consumers also typically compounded by the student debt afforded by the millennials at the moment, and also looking at the tightening bank requirements for home mortgages also make it a lot appealing more for the institutional investors looking to get into multifamily investing.
JP, let me just come in there. So the point he actually wants to make here is that what you find is that because of the high prices of single-family homes, it makes it actually difficult because of the current student debt that the person that actually can afford this or want to move into a single-family home, for him, he can afford it, but the problem is that he's got a lot of debt. The bank requires, because of the previous Great Recession 2008, a bigger deposit. So he needs to save up to that point. You know, that's actually what we just want to say by that point is that it makes it more difficult for them to buy. So that's why it's better to move into this multifamily opportunities.
Yeah, and I think also closely correlating to that is also currently the preference for the consumer, we'll call it your tenant, to be actual remaining in a flexible lifestyle at the moment. He does not want to burden himself with a long-term mortgage at the end of the day. We'll look into, as I said, look into a little bit on the or the millennial impact of that at the moment, but it's purely because of the preference to rent at the moment, why it's so appealing for us at the moment. And also, when you look at another, call it the population area, as the baby boomers at the moment are also looking to downsize because their kids, the millennials, are starting to move out of the house, and their big houses tend to be a little bit open, and they tend to have this, what they call the empty nest syndrome, and they also tend to downscale into the multifamily market, which once again underpins the growing demand for this facility. Now,
interesting enough, JP, is that the stats have actually shown, if you look back at the history, where the baby boomers, actually 70% of them actually owns houses. And statistically, it has actually been seen that only 46% of the millennials actually own houses. You know, so that's the stats tells the story. You know, and what you highlighted there something for us, JP. Just elaborate what you're saying.
Yeah, this is a very interesting graph I actually got from a survey conducted by PwC early in this year, and it does actually show you the recommendations for the asset classes, and you'll see there the top 2 tiers is actually the moderate income apartments and also the affordable apartment homes. And you'll see, and you'll notice typically with our partner that we've aligned at the moment, these are our core focuses in the multifamily sector, and we'll delve into a little bit more detail on why we're going to stay within those markets. But also going a little bit forward, you'll see that Dallas-Fort Worth has been one of the biggest growth rates in the country from the Q1 of 2016 to Q1 this year. And we continue to see that growth happening. And once again, as I said, because of the rental growth that's happening in those areas, it specifically relates to the, as I mentioned, the net operating income of an asset, directly correlating once again to that capital growth, which we as property investors really like to achieve upon the exit of the project specifically. So you can just have a look at the graphs that's supporting that at the moment, that the renter households in the millions by quarter as significantly stacking up to the weight of us who owning those type of assets now. You'll specifically see we've done a lot of webinars on those specific markets where we are involved in, and we really like Texas and we love this, and we've had some opportunities in Houston and Austin as well, and you'll see we'll show you some details on an opportunity in Dallas-Fort Worth. And this, once again, we just want to show you that the growing demand that's happening for the multifamily sector in Dallas-Fort Worth is really outpacing anybody else in the sector at the moment. We'll show you a little bit on why the millennials are so big, but you'll see that the population has the biggest growth of millennials in the, call it the south belt of what you call it America at the moment, and they've got the highest concentration of population at the moment.
Yeah, so I think the reason why there's a lot of millennials flocking to Dallas and to Texas is because of the technology hub of the Texaplex. We've got some other webinars that we've done earlier this year. Go and check out those webinars where we go in more detail into why we like Texas. But this is just again stats, just indicating why the millennials play such a good role in becoming renters.
Yeah, you're absolutely right, William. And I think what we're going to do now, we're going to look into a little bit more what they like to call the millennial effect. I mean, just for you out there, the millennials are currently the population aging anything from about 25 to 25 to about, what was it, 34 or 35. I know it differs depending on the source where you go and look it up. But you can see, I think this picture really does show you the type of lifestyle that is consuming the millennial of age today. And we're going to delve into a little bit on why this is actually prominent for us as a property investor and why we want to tap into this market now. We've noticed several trends over the last couple of months, and specifically this is quite prominent in the States, and a lot of institutional investors are noticing this as well. And we're seeing that the millennials currently do seek smaller and more efficient spaces. I mean, if you look at their parents, typically they always had a lot of stuff. I mean, they had record players and they'd had a lot of vinyls and they'd got books. If you think about today, a millennial at the end of the day, if he wants to move and he wants to pack, everything is actually within his own mobile phone. I mean, he's got all his songs, he's got books on it. He literally lives within a technology space. So that also correlates to that they don't need as much space that what their parents used to live in. So that's one of the trends we've noticed at the moment. And we've also said a little bit that the students are currently trapped in a lot of college debt, meaning that it's also a lot more difficult for them to purchase single family homes or even multi-family homes. So meaning that there's once again a greater demand in the rental market, underpinning why this is such an exciting opportunity for us to get involved. So once again said, millennials do prefer to rent, once again because of the flexibility of the lifestyle that they want to have. I mean, because in the job market today, I mean, they typically change jobs 4 to 5 times over, call it a 10-year career span, so they don't want to fix themselves, as I said, with a long-term mortgage. There's another trend seeing that having tenants signing green leases is a great opportunity to actually increase the efficiency of your income on a property lease, and that's also an opportunity to create value add in the future with that adaptation of green technologies within millennials. Now, what we also know is that the millennials really are in love with technology, and multi-family sectors, and call it the amenities that are actually being implemented in this sector also moves a lot more, giving access and power to your property through the space of technology. I know Billy is also heavily excited about what technology is doing to the property management space, and we also see this as a major trend going forward, which we are looking to capitalize in the next future. I mean, obviously, a lot of people knowing with Wealth Migrate is we leveraging technology, and this is just one of the fundamentals that excites us as well. typically millennials also are seeking affordability while worshiping at the luxuries altar. What this means is they want to live the lifestyle without having to pay for that lifestyle, meaning that it's a lot cheaper to afford to rent a place which is really flashy, and they try to keep up with the Jones without having to purchase those assets in the long run. Going to look in a little bit more on the population growth and call it the net migrations from states in America, you'll see that there's a large outflux at the moment of millennials from states like New York, Boston, Chicago, and your more expensive cities at the moment. Yes, it's highly urban there at the moment, but the prices of living and lifestyle costs are just ridiculously high, and you'll see there's a large outflux of people into different call it markets and states. Now you'll see there that Texas is also the fourth largest net migration at the moment for the millennials, and if you look at the dots there at the top, that's what's really appealing, is that they call it their income per state is really higher as well, meaning that there will also be great, call it or less risk of not paying their rent at the end of the day. So we really see this as a fundamental of affordability and people being really consistent in paying their rents for the properties as well, and which is ultimately what we're looking into as from a property investor perspective. Moving over to the management. If you just look at the management and the maintenance, it's a lot more efficient as to having multiple single residential property homes where you always, if there's a burst pipe, you always have to get somebody moving out to different areas to fix your properties. It just makes more financial sense to outsource this management, to have a management operator that is actively on the ground, involved in that opportunity, or call it project day to day. He knows the heartbeat of that, and if something is wrong, because he knows the property so well, he can really take care of that in a flash. Now, the property management will take, as I said, day-to-day care of those operations and the rentals, and this is obviously, I think, one of the most passive ways to invest in the apartment buildings. And what's really nice about this, you as an investor do not have to have the headache of handling the evictions. I mean, collecting rents, finding this and screening the tenants, and having to take care of the common property maintenance. I think and that's also really important. If you look at these multifamily opportunities, it's important to get into bed with people who have a good quality track record and the property experience in doing this as efficient as possible. I mean, ultimately it comes down to who you partner with, and at the end of the day, I think we've also managed to secure a great opportunity, which we'll share with you a little bit later during the night. Now, what is really fundamentally exciting for me is that you can maximize your opportunities in the multifamily sector whilst you are minimizing your risk. Now, what's nice is you can spread the risk, or call it the spread of the stagnating risk, meaning that within a single family dwelling, the income curve depends on a number of variables that rely on that single family living there. I mean, if you take consideration that family can, for some reason, get they might lose a job and they might struggle to pay your rent. That is your sole income for that property that's going to go down the drain. They might actually damage your property because they don't really care about who's living there, who's owning the property. I mean, there's a number of variables that actually do affect the income of your property from a single tenant household. But similarly, those factors are also prevalent in the multifamily sector. But what's nice about this, you are not dependent on one tenant. With multifamily dwellings, you are no longer engaging with this linear, call it tug and pull relationship on who's having to pay rent and having to take care of everything. With a multifamily opportunity, you actually represent a group of tenants pooling their resources together to pay also for common property maintenance at the end of the day. And should some of these variables actually take place with families losing their jobs or not wanting to pay, as your entire source of income has not been lost. I mean, you've got diversification between, call it 200 and 400 tenants within your opportunity. And I think that's what really, call it a risk mitigating strategy on why it's such an appealing thing for us to look into this market. And not just us, but a lot of people are making us really excited by this. What's nice is that as I said, if you lose one tenant, it's only a small portion of your income. And also, again, it gives you the opportunity to consolidate that unit and maybe do a little bit of a refurbishment, being able to market that property once it's refurbished at a higher rate on the rental that it did achieve up to date. So once again, that's also how you can maximize your opportunities in the similar breath in minimizing your risk from an investment perspective. Now, one thing that's really exciting for me, people said, or there's a very famous Russian proverb that do not buy the house, but buy the entire neighborhood. That's what Billy said. This is what multifamily is. You don't have to own one house, but you can own 400 houses under one title. I mean, giving you commercial access to the, call it the residential space, just makes so much sense in this call it game at the end of the day. But yeah, I don't know if you want to add anything to that.
Yeah, I think what is important is that if you consider this type of investment, the interesting part of it is, and that's what Wealth Migrate brings to this opportunity, is the fact that we've partnered up with a partner in the US that can basically facilitate these properties. They can add some value to the property by renovating it and modernizing it, and then effectively increasing the rent roll, increasing the value of the property. But the thing about what I want to actually emphasize here is the fact that, as you can imagine, 400 units doesn't come cheap. You know, where you've got your family, single family home that can range anything from $150,000 to $1 million. That's just one income stream coming in from it. So if you consider that most of these multifamily apartment, garden apartment blocks is up to between 200 and 500 units, and it's 2 to 3 bedroom units, which means that if you price them, it's quite a big price tag. If you consider the opportunity that we will discuss just now, it ranges from 15 million to 50 million deal value, which makes it a bit impossible for the normal guy just to invest into this opportunity. I know Michiel and Scott has been saying and mentioning in the past, that when they first went to the US, they looked into these opportunities, or saw these opportunities, and they were quite bummed out by the fact that it costs so much to get into this opportunity. Because it's so sought after and the competition is so high, you get 1031s that I'll explain a bit later, guys and institutional guys coming in to this market, because it's such a good sweet spot to get into and effectively get a good income stream for their portfolios, family offices and those kind of things. So it's a very highly competitive market. I think the stats that we saw earlier for last year it's in about 100 billion worth of transactions that basically takes place on a yearly basis because of the sought after market. I think rolling into what the less volatility in different economic cycles. What are we saying when we're talking through this? If we look at effectively, you've got your recession, then the recovery, then the expansion, and then the contraction. So if we look in 2008, when the recession took place, not a lot of new buildings came online. So what happens is that you still, to unlock value, you can buy current assets, renovate them, modernize them, and that's basically the activity that takes place. And that's why the multifamily is sort of completely stable through all various cycles, because when you get the recession stage, the guy cannot afford his single family home, he's been retrenched, so he's going to either move into with family, which probably at that stage also rents, so it's sort of building on it. And then effectively as the market recovers, there's new buildings coming on board online. If you look at the stats, you'll see from 2008 up until 2011, there was no new multifamily buildings actually being built. So effectively, when this whole recovery process takes place, prices starts increasing again on homes and family houses, which then moves the affordability back to a stage where it's a place where people can afford to buy some houses. But then because of the expansion again, the prices starts increasing again to such an stage where the millennials or the first homeowners cannot just come in and purchase a new family house. So effectively they are back into a multifamily because the family is growing, they're big enough, they've got a good job, the kids are on the way, and they want that amenities around them. Not just because from a millennial space, what JP has already made mention to you, if you consider the baby boomers where the empty nest syndrome, so the house is now so big, they want a bit of more a community feel, so that's why they basically come back to the multifamily in all these different cycles, you'll see that the expansion influences the prices. Everything influences the prices to such an extent where your rental base is basically just moving up and down the cycle with it, but effectively the prices are contracting to a certain extent when you get to that sort of contraction stage. But then again, the cycle starts again, and effectively the builders will build less, which then brings up the prices and back and forth. So you'll see on the economical cycle that the tendency will stay the same. It might just be a bit of a contraction on the rental side of it, but in essence, you'll find that the vacancy is usually around 5%. In recession times, it actually goes closer to 100% due to those factors. All right, if we carry on to the next slide, what is important is a partnership. Like I already made mention to, is that the assets is around 50 million. So it's kind of difficult getting into the space, and you need to partner like the PPA group. They've got over 4,000. Sorry, I'm stumbling there over my words. Apologies. Couldn't get that big number out. 4,000 units that they've actually got under management, that they've been awarded Inc. 500, Inc. 5,000. They are one of the top-rated group in this multifamily sector. They specialize in multifamily, and that's one of the reasons why we've partnered up with them. You've probably seen them if this is not your first webinar. You've probably seen Cypress Reach that we've closed a couple of weeks ago. Now we'll touch on the next project, which is Water Reach. But they effectively, they are on the ground. They move fast, and like I said, I wanted to talk a bit about the 1031s. So how we exit in this particular market is through the 1031s. Now they are our bigger competitors, and that's why you need a proper partner that can come in and put down a deposit. So what we've seen with, for instance, at Cypress Reach, for us to get hold of that particular property, we needed to put down almost $200,000 in earnest money. That means that yes, you get it back, but you need to prove that you are committed. So from an individual perspective, that's what makes it challenging. Getting into this market is that it's almost as much as a single family home that you need to put down as a deposit just to prove you're serious in purchasing an asset like this. So the PPA group, they secure this asset. They look into vintage properties where we can add some value to it. And JP, if we can go to the next slide, I'm going to talk about this opportunity a bit more in detail. It's called the Water Reach. Let me just, sorry, I'm interrupting myself because I've actually moved past the 1031 exchange that I wanted to just clarify on. So what happens is, how do we exit a deal of 42 million? I think that's sort of, for me, that's always the big question, is the exit. How can you exit? Because it's one thing in purchasing something, it's got a good cash flow, but effectively you want to know if you can exit in 4 years' time. Now, this is the interesting part, and this is what excites me so much about doing business in the US, in particular the multifamily market, is that with the 1030 exchange, it's a tax diversion vehicle. So what it means is that those investors that actually purchase assets in this size, or has got an asset that's, let's not say, well, we can say that this Water Reach is actually a mom and pop couple that actually bought this and owned this units. And so for them, when they sell this, they can actually move into a 1031 exchange where they defer their tax. So if they move within 30 days in buying a new property, another property, they can roll in that profits into another property and basically selling it off for a profit in a year or two time, and then roll it again. So they effectively diverting their tax, and that's why for us that's the type of target market that will move into this space, because effectively what happens is that we renovate, or I say we, the PPA group, renovates the property, adds value to it, effectively increasing the income stream and the rent that the owner will receive. So when it sells off to a 1030 exchange investor, effectively it means that they make solid profits. They don't have to spend extra money on the building. It's actually just the perfect sweet spot. So that's why we look at a 4-year term on this particular opportunity. For that perspective, is that you've added enough value, and by year 5 and 6, you need to start looking to maintaining those initial units that you already started renovating. So in this particular transaction, JP, we call this, you'll note on the website, we call it level 2. If you guys have been at the workshops, we sort of are rebranding it to what we call an open marketplace. Now what it means is, you'll note that there we're pointing out that the project equity portion that we are partaking in is 1.5, maximum 1.5 million. So we're looking to raise at least 500,000. And for us, this is for the investor as an opportunity to assist in diversifying your portfolio further. So we're not necessarily as Wealth Migrate partaking in this opportunity, but we want you as an investor to have more opportunities. Now, because we know the PPA Group has already done Cypress Reach, and there's another property that we've also invested in. We are comfortable. We've vetted this partner. They've already paid out dividends on Cypress Reach when we purchased them. So we've got a relationship with them. The only caution that I just need to flag is the fact that we are trying to get them to move a bit faster on the dividend payout. So it's paid out quarterly. But at this stage, it's from 45 days to 60 days after the quarter ended. But we're working hard to get it more to a cycle where what we've got with our medical opportunities, where it's after 30 days after the closing. Main reason for it is just sort of the auditing of it and making sure that all the numbers add up and that there's sort of accounted for cash in probably maintenance and stuff that needs to take place for the next quarter. And that's why it takes a bit longer than what we would like it to see. So if we look into the numbers, as I mentioned, it's a 42 million deal value. The property has already been pre-funded, so that's why we've, because of the relationship with the PPA Group, they said to us, well, we want to look into further opportunities. So we're giving you 1.5 million to raise in your own time and give your investors more opportunities. So that's why it's already been funded. If we can raise 500,000, we will be happy. I think we've already raised around 200,000, if I'm not mistaken. So we're almost halfway where we're aiming for. Then the reason why it's such a great thing is that we're purchasing at the 7.78 cap rate, and we believe the compression currently with the capitalizations rates are 6.5. This is quite conservative. In the next 4 years, we should be able to attain that. That'll actually mean that you'll get a return on your investment. That means the year 1, 2, 3, and 4's dividends that you receive, as well as the capital gains, is going to be around 87% return on investment. So it's basically accumulating all those numbers. It's not compounding, it's just simple maths, adding it all together. That'll give you 87% during the course of the 4 years. As you can see, the initial yield is 7.8% that we forecast in year 1. The reason for it is just because of the renovation process taking place. We're just taking a conservative view on it. It's just to make sure that we've added, I think it's around 12% vacancy to it. So it could actually be a bit more, but let's just be conservative because you need to move around the tenants, and that's sort of influencing your return. But as you can see, is over the course of the investment, it does averaging up to almost 9%. I think in year 4, the reason why it's going a bit down is because of the principal payment that kicks in after the initial interest-only period. So let's just show a couple of pictures. Like I think JP already touched on, and what I touched on is Texas. It's in Irving. It's in Dallas. It's close to where Medical 7 is situated. It's a very well located property. As you can see, it's quite picturesque. It's got I think it's a river that you say, JP, that's running there next to it. I think it's around 176 units that still needs to be renovated. So the main reason why we got this at a good deal, we believe, is because of the mom and pop. They've sort of got a bit of marital problems, so they want to go their own ways, and they just want to sell it off because yeah, it's unfortunately life, we could say, JP.
Yeah, I think what's really prominent to when looking at these pictures is not just the quality of lifestyle you can get from renting these units, as opposed to if you want to buy this type of quality single residential house in Texas specifically, it's going to start anything from $230,000 and upwards for these, call it A-class properties. And this is similar to what a lot of our South African investors will actually understand as the quick lock up and go, but with all the lifestyle amenities similar to what we find within the estate environment. So this is actually giving you the opportunity, as Willie said, to own a part of an entire estate complex. And this is what's really appealing because it qualifies as a commercial asset. The banks see it as a really stable asset. They are giving favorable loans to people who are looking to acquire these properties. Hence that, because also, as it said, it's been really resilient during the downturns of the economic cycle at the end of the day. So I think, in short, that is pretty much what we wanted to give you as a tangible takeaway for tonight on the multifamily. Feel free to go and log on to the website for this and maybe see the quality of the finishes. You'll see the website address at the bottom. I want to thank you for your time this evening. We tried to keep it really short and concise. We will be opening the floor for some questions if there's anything at the moment. So, everybody, is there any questions that's come up during the session?
I think there was just one around what is a green lease. It's basically just environmental friendly building facilities. So that was sort of just one question that we've got there. I don't know if there's any other questions that you...
Kanya asked, is this about the multifamily units in USA or in SA? Yeah, Kanya, this is specifically, as you said, opportunities in Texas, in America. Multifamily is not as a familiar sector here in South Africa, although there are certain groups who specialize in doing these, but you don't generally get access to those opportunities, which is also nice from what's happening in the American markets. It's more easily accessible as opposed to here in South Africa. So that's why we're really excited about what's happening on the market. I think maybe let's start rounding off for tonight. I think what's the next steps for you as an investor? I think speak to one of the consultants. If you have any burning questions, we are always there to help you. Book a meeting if necessary. Always find that people like to engage with physical interactions. And go tonight and go log on to the website at www.wealthmigrate.com and maybe browse around and have a look at Water Ridge opportunity. Go play around and see what the brochure looks like. We actually have a very nice project calculator where you can punch in some numbers to see, based on what's actually placed in on this opportunity, what is your expected return in 4 years as well. So we have depicted it, what is it on $10,000, but maybe you have $13,525 to invest, and you can maybe see what it will provide you at the end of the day. And then register on the platform and do your transactions online and be empowered to manage your own portfolio from the power of your own mobile. I think it's really exciting to see where Wealth Migrate is going with this platform at the moment. And we want you to take advantage of the opportunities that we are providing to you as an investor in the call it the new mobile technology era, really.
Yeah, I think the important thing for us as well is from my point of view is please let us know, drop us an email, tell us what you would like to hear more on these webinars, how we can assist you or in the educational journey of becoming more adaptable in the changing environment of property markets. I think if you've missed out on the workshops that we've had over the last week and a half, Willem van der Post spoke a lot about exponential technologies and what influences that is going to have on the market space. So we as Wealth Migrate want to be on the forefront as things are changing and evolving. That's one of the reasons why we've partnered up with a guy like Roger Hamilton, where they've got what they call a co-working environment that's sort of trending now. If you're looking into commercial space, that's why we're sort of careful. If you look into commercial buildings, the whole co-environment changes that's taking place globally. people want to be working more in a community environment like the millennials. They want to work and live in the same spaces, in the same areas, so that's the kind of things that we need to take into consideration. If we consider now, for instance, a retail space, some of you might ask why we don't go into a retail arena. If we consider Take-A-Lot and all those different e-commerce and the shift towards people going online and basically ordering their goods from a commercial space, it means that there's we've seen like
there's a high tendency risk involved. And
yeah, we've seen what's that? Sears. I think Sears is closing a lot of stores in the US. So this is the type of influences that we take into consideration, and that's why I'm mentioning this is that we want you to send us, drop us a mail, let us know how we can assist you more in understanding it. I've seen we've got a question now. Okay, it is from Ken. I googled multifamily, and one of the things that really pumped me up was the interest rates for residential properties are quite a bit higher than the commercial property. Water Reach interest rate seems high, or is it a commercial rate? Good question, Ken. Yeah, so that's the thing. If we consider now, we've recently launched the hassle-free product, as we call it, which is basically for our previous, in the IPS space, we had investors investing in single-family homes, and the interest rates that they've got for those single-family homes was between 9.75% to 12%. So if you consider now the interest rate that we actually are getting in the for the multifamily, because it's a commercial asset, we're talking around anything from 4.75%. The market is moving. We'll see next week what the Fed is going to do. There is definitely an interest rate risk, and that's usually what we try to do is fix those rates. In Water Reach, we forecasted it on a floating rate, which actually incrementally increases over time. But I have to be honest, we need to just finalize it because the fixed rate will probably be more appropriate. But what we find with the PPA group is that they actually do not necessarily opt for a fixed rate. They choose a floating rate, but they actually take out what they call a cap rate option on the interest rate, which effectively that means is that the interest rate cannot go up to a specific higher as 6.5%. So if you then consider 6.5% over a period of 4 years in relation to 12%, that is 50% less, which means that 50% comes back to the investor's pocket. So good question, Kevin. Thanks for that.
I see Johnny Verster actually does ask here, when does this investment opportunity close? As we said, we're only looking at to raise our first 500, and we're about halfway there, and we're looking to close that out within the next 2 weeks. But similarly, if we do find interest in the next 2 weeks, we might be able to take up another 500 and even the 500 after that. So we'll be looking to close the first phase in the next 2 weeks, and if there's high appetite, we'll look at opening that up for another 2 weeks. So I would say realistically, let's call it the end of June, middle July, we're looking to close this off and have this as a closed-end opportunity running on the platform. Yeah. Thank you for all the questions, and I think that's us for tonight. We try to keep this very short and clear. I want to thank Billy once again for sitting in and sharing some of his knowledge. I mean, he's been on the ground there. He's been in the commercial sector and analyzing. It's always a privilege to share some information with the investors out there. And Billy, I want to thank you for your time.
Yeah, no, thank you, JP. I think tonight you've done most of the chunk of the talking. Yes, please get in contact with us. Let us know how we can assist you guys more.
So just the last question I see here, Pierre van der Berg asked, will the first phase start to earn dividends? Pierre, that's correct. So as we mentioned, the opportunity has already been pre-funded. So the project has already started running and delivering their, call it income. So as soon as we raise our $500,000, you will be liable for your interest as soon as as your money hits the bank. So we'll be able to pay you the interest when it actually lands in the escrow. So yes, if you invest today, you will be actually call it privy to some income until that, call it the shares are listed on the Seychelles. Yes. I think that is all the questions for tonight. I think before maybe anything else comes in, we are happy to answer them, but it looks like it pretty much subsided. So thank you very much for everybody's time tonight. Hope it didn't take too long, and there's some tangible things that you can take away, and we look forward to see you on the next webinar. Thank you very much.
Bye-bye.